You are currently sitting in front of your monitors, watching a 5-minute candle close, and you feel that familiar, hollow ache in your chest. You have spent 3 years, maybe 5, or even a decade trying to crack this code. You have read every book on price action, you have backtested 17 different strategies, and you have paid for 3 different Discord signals groups. Yet, your equity curve looks like a flat line with occasional violent dips into the red. You are not a complete novice anymore, because you know what a Fibonacci retracement is, and you understand the basic mechanics of a limit order. But you are stuck in the most dangerous place a trader can inhabit, the permanent beginner phase. This is the purgatory of trading. It is the stage where you have enough knowledge to be dangerous to your bank account, but not enough wisdom to protect it. The brutal truth is that most traders never leave this phase. They don't fail because they are stupid or because they lack hustle. They fail because they are subconsciously addicted to the cycle of starting over. They are addicted to the new strategy high and the "this time it's different" delusion. If you feel like you are running on a treadmill that is slowly moving toward a cliff, this video is for you. We are going to dismantle the psychological and mechanical traps that keep you at the entry level. We are going to talk about why your brain is biologically hardwired to make you a losing trader. I am going to show you exactly why your risk management is actually just a sophisticated way of slow bleeding your capital. By the end of this deep dive, you will realize that the secret isn't a better indicator, but a complete demolition of how you view probability. If this perspective shift helps you finally see the market for what it actually is, consider subscribing to the channel. We don't do to the moon hype here. We do the clinical analysis of what it takes to survive the professional arena. Let's start by looking at the first great lie of the beginner phase, the belief in the golden setup. Beginners spend 90% of their time looking for the perfect entry. They think that if they can just find the right combination of indicators or the right secret candlestick pattern, the money will flow automatically. This breaks your brain because it frames trading as a game of prediction rather than a game of probability. A professional trader does not care about being right on any single trade. An amateur trader feels a personal sting every time a stop loss is hit because they viewed that trade as a test of their intelligence. When you are in the beginner phase, you treat every trade like a mini drama. You watch every tick. You move your stop loss to break even too early because you are terrified of losing the $50 of unrealized profit you see on the screen. This is why you stay a beginner. You are managing your emotions, not your edge. Let me show you exactly why your strategy hopping is killing your progress. Every time you lose 3 trades in a row with a strategy, your brain tells you the strategy is broken. You go back to YouTube, find a new 90% win rate strategy, and the cycle resets. You never allow yourself to see the statistical distribution of a strategy over a large sample size. You are effectively trying to judge the fairness of a coin by flipping it twice. If it comes up heads twice, you think it's a magic coin. If it comes up tails twice, you throw it in the trash. This is the definition of insanity in a probabilistic environment. The beginner thinks the market is a puzzle to be solved. The professional knows the market is a stream of random outcomes that can be exploited through disciplined math. Let's talk about the math that nobody wants to hear. Most of you are trading with accounts that are too small to support the lifestyle you want. Because you want to turn $1,000 into $100,000 in 6 months, you take on massive leverage. You risk 10% of your account on a single trade. Statistically, you are guaranteed to ruin your account. Even with a strategy that wins 60% of the time, the probability of having 5 losers in a row at some point in a series of 100 trades is extremely high. If you risk 10% per trade, a normal streak of bad luck will wipe out 50% of your capital. At that point, you need a 100% return just to get back to where you started. This is the math of ruin. The beginner phase is characterized by an obsession with, how much can I make? The professional phase begins when you start obsessing over, how much can I afford to lose? Here is what nobody tells you about the pro transition. It is incredibly boring. If your trading feels like an action movie, you are doing it wrong. If your heart is racing when you click buy, you are over-leveraged or you don't have a plan. Professional trading is a clinical, repetitive, and almost soul-crushing exercise in patience. It is waiting 4 hours for a specific price level to be hit, only to not take the trade because the volume didn't confirm the move. The beginner can't handle that. The beginner feels like they are missing out if they aren't in a position. They have active trade syndrome. They think that being a trader means trading. In reality, being a trader means managing risk and waiting. The market does not owe you a setup every day. The market does not care about your monthly rent or your desire to quit your job. One of the hidden variables that amateurs ignore is the concept of market regime. A beginner learns a strategy that works in a trending market. They make some money for 2 weeks and think they are geniuses. Then, the market shifts into a choppy, sideways range. The strategy starts taking losses. Instead of recognizing that the market environment has changed, the beginner thinks they have lost their touch. They start revenge trading to get back the money they lost. They double their position size on a sure thing to break even. This is how a 2-week winning streak ends in a total account blow-up in a single afternoon. This happens because the beginner is looking at the chart, but they aren't seeing the context. They are looking for their pattern, like a child looking for shapes in the clouds, ignoring the fact that a storm is brewing. To escape the beginner phase, you must make the first major shift. Stop looking for the answer and start building the process. Your process is everything that happens when you aren't looking at a live chart. It's your pre-market routine. It's your journaling of every single trade, including the ones that you messed up. It's your weekly review where you look at your losers and ask, did I follow my rules? If you lost money but followed your rules, that was a good trade. If you made money but broke your rules, that was a bad trade that will eventually lead to your downfall. The beginner cannot comprehend this. To the beginner, the only good trade is one that results in a green number. This is the most dangerous feedback loop in finance. Positive reinforcement for bad behavior is how you build the habits that will eventually cost you $50,000. Let's talk about the learning curve delusion. In most professions, there is a direct correlation between effort and results. If you study harder for a medical exam, you will likely get a better grade. In trading, you can work 14 hours a day, analyze every data point, and still lose $2,000 by 10 in the morning. The market does not reward effort in the way we are taught as children. It rewards alignment. Alignment with the trend, alignment with order flow, and alignment with your own psychological limits. Most traders stay beginners because they try to outwork the market. They think if they add more indicators or watch more time frames, they will have more control. Control is an illusion. The only thing you control is your entry, your exit, and your position size. Everything else is up to the collective madness of the global participants. Another reason you are stuck is that you are probably misinterpreting market data. You see a support level, and you think it's a floor that price won't go through. You don't realize that a support level is just a collection of orders that can be exhausted. The more times a support level is tested, the weaker it usually becomes, because the buy orders are being filled and removed. The beginner thinks, it's hit this level 4 times. It's a super strong floor. The professional thinks, there are no more buyers left at this price. It's about to collapse. This is a fundamental misunderstanding of supply and demand mechanics. It's the difference between looking at the surface and understanding the engine. Let's move into the second part of this deep dive. We need to talk about the identity crisis. Most of you don't want to be traders. You want to be people who have a lot of money. There is a massive difference. If you want to be a trader, you have to love the process of data analysis and risk management. If you just want the money, you will take shortcuts. And the market is a machine designed to transfer money from the shortcut takers to the process followers. Think about your last 10 trades. How many of them were planned the night before? How many of them were impulses because you saw a big green candle and didn't want to miss the move? That FOMO, fear of missing out, is a biological relic of our ancestors. In the wild, if the tribe starts running, you should probably run too. In the market, if the crowd is running, you are usually the liquidity for the exit of the big players. To win, you have to unlearn your human instincts. You have to learn to buy when it feels scary and sell when it feels euphoric. This is why trading is the hardest way to make easy money. It requires you to fight your own DNA every single day. Let's look at the professional shift, number 2, the acceptance of uncertainty. The beginner wants to be sure. They ask, is the market going up today? The professional says, I don't know and I don't care. If it goes above point A, I have a 55% chance of reaching point B. If it goes below point C, my thesis is wrong and I am out for a small loss. That's it. That is the entire secret to professional trading. It's a series of if-then statements, executed with the cold precision of a computer. If you can't write your strategy on the back of a business card, it's too complicated. And if it's too complicated, you won't be able to execute it under pressure. The complexity trap is a major reason traders never escape the beginner phase. They think that a simple strategy like a moving average crossover is too easy to work. So they add Bollinger Bands, and then an RSI, and then they start looking at moon phases or some obscure Gann theory. They end up with analysis paralysis. By the time all their indicators align, the move is already over. Or worse, the indicators give conflicting signals, and they freeze. Meanwhile, the pro just looked at the break of a daily high on high volume and made $10,000 while the beginner was still drawing lines on their chart. Let's talk about drawdown. This is the part that kills most dreams. Drawdown is the period where your strategy is out of sync with the market. Every trader, even the legendary ones, goes through drawdowns. The beginner reacts to drawdown by changing their strategy. The professional reacts to drawdown by reducing their position size and sticking to the plan. The beginner views a drawdown as a failure. The professional views a drawdown as the cost of doing business. Imagine you owned a physical store. You have to pay rent, electricity, and staff. Those are your losses. You don't close the store just because you had to pay the electric bill. In trading, your stop losses are your operating expenses. Your winners are your revenue. If your revenue is higher than your expenses over the long term, you have a business. If you treat your stop losses like a personal tragedy, you have a hobby. And hobbies cost you money. Businesses make you money. The third major shift you need to make is moving from outcome dependence to process adherence. You need to stop checking your P&L, profit and loss, during the day. Looking at the dollar amount you are up or down triggers the emotional center of your brain. If you see you are up $500, you start thinking about what you can buy with that money. You become afraid of the market taking it back, so you exit too early. You just clipped your winner. If you see you are down $500, you feel pain. You don't want to realize that loss, so you move your stop loss just a little bit further to give it room to breathe. You just inflated your loss. This is why most traders have a negative expectancy. They take small wins and huge losses. Even if they win 70% of the time, the 30% of the time, they lose wipes out everything and more. To escape the beginner phase, you must flip this. You must be tight with your losses and loose with your winners. You have to let the market prove you wrong quickly and prove you right slowly. This is incredibly uncomfortable. It feels wrong to watch a $1,000 profit turn back into $500. But if your target was $2,000 based on the math of the setup, you must stay in. The professional is disciplined enough to let the trade hit the target or the stop. The beginner is a manager who interferes with the trade because they can't handle the tension of uncertainty. Let's break down the false prophecy of the retail trading world. The industry is designed to keep you a beginner. Brokers want you to trade frequently because they make money on the spread and commissions. YouTube gurus want you to believe it's easy, so you buy their $2,000 course. They show you the Lamborghini and the laptop on the beach. Trading on a beach is actually impossible. The glare is too high and the Wi-Fi is terrible. It's a lie. Real trading happens in a quiet room, usually in the early hours of the morning, with a cup of black coffee and a spreadsheet. It is a brutal truth that most people are not psychologically equipped to be traders. They lack the self-awareness to recognize their own biases. They are prone to confirmation bias, where they only look for news that supports the trade they are already in. If they are long on Bitcoin, they only read the bullish articles. They ignore the bearish warning signs. The professional is always looking for reasons why they might be wrong. They are their own devil's advocate. They ask, who is on the other side of this trade, and why are they selling to me? If you can't answer why someone smarter than you is taking the opposite side of your trade, you are the sucker at the table. Let's talk about account size and the slow path. Everyone wants the fast path. They want to flip an account. Flipping an account is just gambling with better terminology. If you double an account in a week, you used a level of risk that will eventually result in a zero. The slow path is making 3% to 5% a month consistently. If you make 5% a month on a $100,000 account, you are making $60,000 a year. That is a life-changing career. But 5% a month sounds boring to a beginner. The beginner wants 100% in a month. And because they chase 100%, they get minus 100%. The professional shift number 4, Respect the power of compounding. You don't need to be a millionaire by Friday. You need to be a profitable trader for the next 30 years. If you can master the small numbers, the big numbers will eventually find you. Institutional capital, the real money, is looking for consistency. If you can show a track record of 2 years with a steady equity curve and controlled drawdowns, you can get access to prop firm capital or outside investors. You don't need your own $100,000. You need the skill that makes $100,000 useful. Most beginners are trying to build a skyscraper on a foundation of sand. They don't have the discipline, the journal, or the emotional control. Even if you gave a beginner a $1 million account tomorrow, they would lose it. They would lose it because they haven't earned the psychological capacity to manage that much risk. The pain of a 1% loss on $1 million is $10,000. If you haven't trained your brain to handle a $100 loss on a $10,000 account, you will freeze when you see $10,000 vanish in a heartbeat. Trading is a performance sport. Like an Olympic athlete, you have to train the fundamentals until they are subconscious. The fundamentals aren't support and resistance. The fundamentals are patience, discipline, and emotional regulation. Let's talk about the hidden mechanics of the market that beginners ignore: liquidity. The market is not a chart of price. The market is a chart of liquidity. Price moves to areas where there are the most orders to be filled. Big players, banks, and hedge funds need a lot of orders to enter or exit their positions. They can't just click buy for $500 million without moving the price against themselves. They need to find retail liquidity. Where is retail liquidity? It's right above the recent high and right below the recent low. It's where your stop losses are. This is why stop runs happen. Price fakes out a level, hits all the stops, and then reverses in the direction you originally thought it would go. The beginner screams, "The broker is cheating me," or "The market is rigged." The professional understands that this is just the mechanics of the auction. The big players needed those stops to be hit so they could fill their own orders. If you want to escape the beginner phase, you have to stop placing your stops where everyone else does. You have to think, if I were a predator, where would I find the most food? The food is the retail stop loss. Once you start seeing the game behind the game, your entries will change. You will start waiting for the fake out before you enter. You will start being the one who provides the liquidity, not the one who gets consumed by it. Let's move into the final dimensions of this deep dive. We need to discuss overtrading. The beginner phase is often a blur of activity. You feel like you are working hard because you made 50 trades today. In reality, you just paid your broker $200 in commissions and took yourself on an emotional roller coaster for no reason. High-quality setups are rare. Think of yourself as a sniper, not a machine gunner. A sniper waits in the brush for 3 days for one perfect shot. If they miss, they don't start firing wildly at everything that moves. They retreat, reset, and wait for the next opportunity. Kinesidad. If you can't go a full day without trading, you aren't a trader. You are an addict. You are addicted to the dopamine of the uncertain outcome. This is the same mechanism that keeps people at slot machines. The variable reward is the most addictive force in nature. To beat this, you need rules. I will only take a maximum of 2 trades per day. If I lose 2 trades, I am done for the day. I will only trade the London and New York sessions. These rules aren't there to restrict your freedom. They are there to protect you from your lizard brain. Your lizard brain is the part of your mind that wants to fight the market when you lose. It wants to revenge trade. It wants to prove the market wrong. You cannot win a fight with the market. It is like trying to fight the ocean. The ocean doesn't know you exist. It will just drown you and move on to the next shore. The identity change required to be a professional is a move toward radical accountability. The beginner blames the Fed. They blame Elon Musk's tweets. They blame lagging indicators. The professional takes 100% responsibility for every red cent that leaves their account. Even if a black swan event happens, a sudden, unpredictable market crash, the professional blames themselves for not having a plan for that scenario. When you take absolute ownership, you gain absolute power. If the failure is someone else's fault, you are helpless. If the failure is your fault, you can fix it. Let's talk about the journal again, because 99% of you aren't doing it right. A journal isn't just a list of prices. It's a diagnostic tool. You should record your emotional state before the trade. Were you bored, anxious, angry? You will start to see patterns. Maybe you lose 80% of the trades you take when you are bored. Maybe you make 90% of your profit on Tuesday mornings. If you have that data, you can stop trading when you are bored and double your size on Tuesday mornings. That is how you optimize an edge. The beginner is guessing. The professional is iterating. The beginner phase is a random walk. The professional phase is a calculated ascent. One of the most brutal truths is that you might have to unlearn everything you think you know. You might have to delete your 50 indicators. You might have to stop following every trading influencer on Twitter. You might have to go back to a demo account for 3 months to prove you can follow a simple plan. Most traders won't do this. Their ego won't let them. They would rather keep trying and losing than admitting they need to restart the foundation. This is why the 95% of traders fail statistic is so persistent. It's not that trading is impossible. It's that self-correction is painful. It is painful to look at your bank statement and realize you wasted $10,000 because you were arrogant. It is painful to realize you aren't as disciplined as you thought you were. But on the other side of that pain is competence. Competence is the quiet confidence that you can handle whatever the market throws at you. It's not the high of a winning trade. It's the stability of a winning year. Let's talk about the mental models of the top 1%. They view the market as a complex adaptive system. It's not a machine where A plus B equals C. It's a living organism that changes its behavior based on the participants. This means you have to be adaptive. You have to have a core philosophy, but you must be flexible in your tactics. If the volatility doubles, your stop losses must double in width, and your position size must be cut in half. If the market becomes dead and quiet, you must stay on the sidelines. The beginner tries to use a hammer for every problem. The professional has a toolbox. Let's look at the paradox of choice. The more markets you watch, the worse you will perform. Beginners watch gold, oil, the S&P 500, Bitcoin, and 17 Forex pairs. They have information overload. They are jack of all trades, master of none. The professional usually specializes. They know the personality of 1 or 2 instruments. They know how NASDAQ moves during the New York Open. They know the fake-outs that are common in Eurodollar. By narrowing your focus, you increase your pattern recognition. You start to feel the rhythm of the price. You can't feel the rhythm if you are constantly switching channels. Pick one instrument, one time frame, one setup. Master that for 6 months. If you can't make money with one setup on one pair, adding more will only make you lose money faster. Let's discuss the final shift, the shift from trading for money to trading for excellence. If you focus on the money will run away from you. If you focus on executing your plan perfectly, the money will eventually chase you down. It sounds like Zen nonsense, but it is the most practical advice in finance. The money is just the scoreboard. The game is your decision-making. Every time you make a correct decision, regardless of the outcome of the trade, you win. Every time you make an incorrect decision, regardless of whether you made money, you lose. If you can maintain this frame for 100 trades, you will no longer be a beginner. You will be a developing professional. The transition is not a moment. It is a gradual erosion of your bad habits. It is the day you decide that you are tired of being a gambler. It is the day you decide that you would rather be consistent than right. It is the day you stop looking for the next big thing and start looking at your own reflections. The market is a mirror. It shows you exactly who you are. If you are impatient, the market will take your money. If you are greedy, the market will take your money. If you are disorganized, the market will take your money. The only way to beat the market is to beat yourself. This deep dive has been a confrontation. It was meant to be. You cannot grow in a comfort zone. You have to accept the brutal reality that your current approach is not working, and that is okay. Accepting that you are stuck is the first step to getting unstuck. Stop being the perpetual beginner. Stop the strategy hopping. Stop the over-leveraging. Start the journaling. Start the risk management. Start the self-mastery. The market will be there tomorrow, and the day after that. The opportunity is infinite. Your capital is finite. Protect your capital. Master your mind. If this video has challenged your perspective, I want you to do one thing. Go to your trading journal, or start one today, and write down the one habit that you know is keeping you in the beginner phase. Is it moving stops? Is it FOMO? Is it lack of a plan? Be brutally honest with yourself in the comments below. The first step to identity change is public accountability. If you want more deep dives that ignore the hype and focus on the mechanics of success, hit the like button and subscribe. It tells the algorithm that you value substance over clickbait. We are building a community of serious traders here. People who are in this for the long haul. People who understand that wealth is a system, not a lottery ticket. I will see you in the next deep dive. Outro emphasis. End of video. Until then, stay disciplined. Stay patient. And remember, the market doesn't care about your opinion. It only cares about your execution. Let's get to work. The beginner phase ends the moment you decide to stop being a consumer of information and start being a producer of results. Every professional was once a struggling beginner who refused to quit and refused to lie to themselves. You have the tools. You have the knowledge. Now you need the will to apply it with absolute consistency. It won't be easy, but it will be worth it. I'll be watching your progress. Good luck with your next session. Make it a professional one. Turn off the noise. Focus on the signal. Your equity curve is waiting for you to take it seriously. The market is the ultimate meritocracy. It doesn't care about your background, your degree, or your reason. It only cares about your actions. Make your actions count. I'll see you in the next one.